Something is happening right now that should be on every front page in America, but it is not, because the implications are so catastrophic that almost nobody wants to admit what it actually means. 5 major nations spread across 3 continents representing over 2 billion people and $16 trillion in combined economic power are simultaneously dumping United States Treasury bonds, not slowly, not cautiously, aggressively. In the past 18 months, China, Japan, Saudi Arabia, Brazil, and India have collectively sold over $400 billion in American government debt. $400 billion. That is more than the entire economy of Austria. That is twice the GDP of Vietnam. And it is moving out of US Treasuries and into assets that do not depend on American stability or dollar dominance. Let me be clear about what this means. US Treasury bonds have been considered the safest investment on earth for over 70 years. Every central bank holds them. Every pension fund owns them. Every financial institution uses them as collateral. They are the foundation of the entire global financial system. When 5 major countries start dumping these bonds all at once, they are sending a message. They are saying they do not trust the United States to manage its debt anymore. They are saying the dollar is not as safe as everyone believes. They are saying the era of American financial dominance is ending. And the timing matters. This is not happening during a crisis when everyone panics. This is happening now in early 2026, when stock markets are near all-time highs, when unemployment is historically low, when the Federal Reserve claims everything is under control. The selling is calculated. It is strategic. And it is coordinated enough that you have to ask whether these countries are talking to each other. Together, these 5 nations hold nearly $3 trillion in US debt, and together, they are exiting at a pace never seen before in peacetime. The cascade has already started, and most Americans have no idea. Before we show you exactly which countries are selling, how much they are dumping, why they are moving at the same time, and what this means for your savings and your ability to maintain your standard of living, hit that subscribe button and join the Wealth Forum. We expose the economic earthquakes before they destroy your wealth. Turn on notifications, because when the world loses faith in American debt, everyone holding dollars is about to face consequences they did not see coming. Now let's talk about how we got here, and why this is different from anything we have seen before. Let's go back to 1944, Bretton Woods. The global financial order was being rebuilt after World War II. And the United States made every other country an offer. Peg your currency to the dollar, and we will peg the dollar to gold at $35 per ounce. It was a brilliant system. It made the dollar the center of global trade. And it worked until 1971 when Richard Nixon ended the gold standard. The dollar was no longer backed by gold. It was backed by trust. Trust in American economic strength. Trust in American fiscal discipline. Trust in American power. For 50 years that trust held. Countries bought Treasury bonds not because they loved America, but because Treasuries were safe, liquid, and essential for global trade. If you wanted to buy oil, you needed dollars. If you wanted to trade internationally, you needed dollars. And if you had excess dollars, you bought Treasuries because they paid interest, and you could sell them any time. This created a virtuous cycle. Global demand for dollars kept the dollar strong. A strong dollar allowed America to borrow cheaply. Cheap borrowing allowed America to run deficits without consequences, and those deficits funded military dominance, which maintained the global order that kept everyone buying dollars. But that cycle is breaking, because the foundation of the system was trust, and trust is evaporating. In 2000, the US national debt was $5.6 trillion. Today it is $38 trillion. In 2000, the US ran a $236 billion surplus. Today the deficit is $2 trillion per year. In 2000, interest on the debt was $362 billion annually. Today it is $1.1 trillion and climbing. The math has changed, and foreign creditors see it. Here is the analogy. Imagine you lend money to a friend. At first, they borrow $10,000 and pay you back on time. So you lend them $20,000. They pay that back too. So you lend them $50,000, but then they start borrowing faster than they are earning. They borrow $100,000, then $200,000, then $500,000, and their income is not growing. At some point, you stop lending, not because you hate your friend, but because the math does not work anymore. That is what is happening to America. The 5 nations are not enemies. They are creditors who did the math, and the math says get out now. Now let's talk about the mechanics. How does selling Treasury bonds actually work? And why does it create a cascade that feeds on itself? Here is how the Treasury market works. The US government needs to borrow $2 trillion per year to cover the deficit. It does this by issuing Treasury bonds. Investors buy those bonds. The government gets cash today and promises to pay it back with interest over 10, 20, or 30 years. For decades, there was always more demand than supply. Every auction was oversubscribed. The US could borrow at incredibly low rates because everyone wanted treasuries. But when major holders start selling, the dynamic reverses. More supply hits the market, demand drops, and prices fall. When bond prices fall, yields rise. Yields are the interest rate the government has to pay. If a 10-year treasury yield goes from 3% to 5%, the government's borrowing costs explode. And here is the trap. Higher borrowing costs increase the deficit. A bigger deficit requires more borrowing. More borrowing floods the market with supply. More supply with less demand pushes yields even higher. It is a doom loop. And it feeds on itself. Let me show you with numbers. Right now, the US pays about 1.1 trillion per year in interest on 38 trillion in debt. That is an average rate of about 3%. But new bonds are being issued at 4.5%. As old bonds mature and get replaced with new bonds at higher rates, the total interest burden climbs. If the average rate goes to 5%, interest payments hit 1.9 trillion per year. If it goes to 6%, interest hits 2.3 trillion. That is almost half of all tax revenue just for interest. Not for roads, not for defense, not for social security, just interest on past borrowing. And here is where it gets dangerous. If foreign buyers disappear, someone has to replace that demand. There are only three options. Option one is domestic buyers, American banks, pension funds, insurance companies, but they are already holding trillions in treasuries. They do not want more. Option two is the Federal Reserve. The Fed can print money and buy bonds, but that causes inflation. And inflation just came down from 9% to 3%. The Fed does not want to reignite it. Option three is to let yields rise until they are attractive, enough to bring in new buyers. But if yields go to 6 or 7%, the government cannot afford the interest. The system breaks. This is not theoretical. This is exactly what happened in the UK in 2022. The British government announced a massive spending plan funded by borrowing. The bond market revolted. Yields spiked. The pound crashed. And within 3 weeks, the Prime Minister was forced to resign. The bond market has power. And when it loses confidence, governments fall. The same thing can happen to America, except the consequences would be global, because the dollar is not just Britain's currency, it is the world's currency. And treasuries are not just Britain's debt, they are the foundation of the entire financial system. Now let me show you what each of the 5 countries is doing, and why they are all selling at the same time. Start with China, the second largest economy in the world, and the second largest holder of US debt. In 2013, China held 1.3 trillion in treasuries. Today they hold 760 billion. They have dumped 540 billion over 12 years. That is a 42% reduction. And the pace is accelerating. In the past 18 months alone, China sold 136 billion, more than they sold in the previous 3 years combined. This is not portfolio rebalancing. This is an exit strategy. Why? 3 reasons. First, geopolitical tension. The US-China relationship has collapsed since 2018 trade wars, tech sanctions, Taiwan, military confrontation. Every escalation makes China more vulnerable to having their treasury holdings frozen. They watched what happened when the West froze 300 billion in Russian assets after Ukraine. China does not want to give America that leverage. Second, de-dollarization. China has spent a decade building alternatives. The Belt and Road Initiative, the Asian Infrastructure Investment Bank, currency swaps with dozens of countries, the digital yuan, all designed to reduce dollar dependence. Selling treasuries fits perfectly. Why hold dollars when your goal is to replace the dollar? Third, domestic needs. China's economy is slowing. Real estate is collapsing. Local government debt is exploding. They need capital at home to stabilize the economy. But here's the critical part. China is not just selling treasuries. They are buying gold, massive amounts of gold. In 2023, China bought more gold than any other central bank in the world, over 295 tons. In 2024, they continued. In 2025, they accelerated. Their gold reserves have increased from 1,054 tons in 2013 to over 2,264 tons today. At the same time, treasury holdings fell from 1.3 trillion to 760 billion. That is not coincidence. That is strategy. Gold is the ultimate hedge against dollar decline. China is betting the dollar's dominance ends within a decade, and they are positioning accordingly. Now Japan, the largest foreign holder of US debt. As of late 2025, Japan holds $1.15 trillion. But at their peak in 2022, they held $1.3 trillion. They have reduced holdings by $150 billion in 3 years. This is America's most loyal ally. For decades, Japanese institutions were the reliable buyers when others stepped back. If Japan is selling, something fundamental has changed. And the reason is simple: economics. For 30 years, Japan had zero interest rates. Japanese investors had to buy foreign bonds to earn any return. US Treasuries paying 2% looked great when Japanese bonds paid 0. But in 2024, the Bank of Japan finally raised rates after 3 decades. Japanese 10-year bonds now yield 2.4%. Suddenly, Japanese investors can earn decent returns at home without currency risk. So they are repatriating capital, selling treasuries, buying Japanese bonds. This is not hostile. This is rational, but the effect is the same. Less demand for US debt, and Japan's selling accelerated dramatically in early 2025, as they sold $119 billion in just 3 months, the steepest quarterly drop since 2012. What triggered it? Trump tariff threats caused market volatility. Japanese investors panicked and sold. Japanese yields kept rising, making domestic bonds more attractive. Here is the trap for America. Japan is not selling to hurt the US. They are selling because it makes financial sense. But when your largest creditor dumps $119 billion in 90 days, who replaces that demand? Who buys what Japan is selling? The answer is nobody, and that is the problem. Now Saudi Arabia, and this one might be the most dangerous of all, because Saudi Arabia is not just selling treasuries. They are breaking the petrodollar system that has supported dollar dominance for 50 years. Saudi Arabia held $135 billion in treasuries as of mid-2025, as down from $184 billion in 2020. They have cut holdings by 27% in 5 years. But the numbers tell only part of the story. What matters more is what Saudi Arabia is doing with oil. For 50 years, Saudi Arabia sold oil exclusively in dollars. Every barrel required dollar payment. This created massive global demand for dollars. Countries needed dollars to buy energy. That demand supported the dollar's value and allowed America to run deficits that would have crashed any other currency. But in June 2024, Saudi Arabia let expire a decades-old agreement with the US on oil sales. Now they accept yuan, euros, rupees. They are still selling most oil in dollars. But the exclusive arrangement is gone, and the trend is clear. In December 2024, Saudi Arabia signed a $50 billion energy deal with China. Payable in yuan, that is $50 billion of trade that previously required dollars. Now it does not. When demand for dollars falls, the value of dollar assets falls. Why is Saudi Arabia doing this? 3 reasons. First, they watched Russia. When Russia invaded Ukraine, the West froze Russian central bank assets. Saudi Arabia understands that if they anger the US, their treasury holdings could be frozen too. Diversification protects against that risk. Second, they see the power shift. China is now Saudi Arabia's largest oil customer. Asia is growing. America and Europe are stagnant. It makes sense to align with growth. Third, they are angry about American energy policy. The US became a major oil producer through fracking. American production competes with Saudi production. The Biden administration talked about transitioning away from fossil fuels. The Saudis see that America is not the reliable partner it once was. When Saudi Arabia breaks the petrodollar, when they accept yuan for oil, when they cut treasury holdings, they accelerate the end of dollar dominance. Because if oil is no longer priced exclusively in dollars, one of the main reasons countries hold dollars disappears, and the entire structure supporting American debt becomes unstable. Now Brazil and India, these two represent something different. They are not traditional creditors like Japan. They are not rivals like China. They are rising powers making strategic choices about alignment. Brazil held $241 billion in treasuries at peak. Now they hold $225 billion, a $16 billion reduction. India held $244 billion at peak. Now $211 billion, a $33 billion cut. Both are part of BRICS. Brazil, Russia, India, China, South Africa, plus new members added in 2024, Saudi Arabia, UAE, Egypt, Ethiopia, Iran, BRICS, now represents 46% of global population and 36% of global GDP. This is not marginal. This is half the world. BRICS has been building alternative payment systems to bypass the dollar. The new development bank, currency swaps, discussions about a common BRICS currency. None of this has replaced the dollar yet. But the infrastructure is being built, and Brazil and India reducing Treasury holdings is part of this shift. They are diversifying, building trade that does not require dollars, preparing for a world where the dollar is not the only option. Why does this matter? Because Brazil and India are not hostile to America. They are democracies. They have good relationships with the US, but they are pragmatic. They see unsustainable deficits, political dysfunction, debt exploding, and they are reducing exposure not to hurt America, but because holding too many treasuries is risky. When friendly countries diversify away from your debt, that tells you something. It tells you that even allies do not believe your fiscal situation is sustainable. And it tells you the world is preparing for a future where America is not dominant. So why are all five selling at the same time? Because multiple factors have converged. American debt reached $38 trillion. Debt to GDP is 124%. Annual deficits are $2 trillion. Interest payments are $1.1 trillion. These are not manageable numbers. These are crisis numbers. Foreign creditors see them, and they are exiting before the crisis hits. Now let me show you what happens next. Because when 5 nations dump $400 billion, that is not the end. That is the beginning. Here is what happens when the selling creates a cascade. When major holders dump bonds, prices fall. When prices fall, yields rise. When yields rise, borrowing costs increase. When borrowing costs increase, the deficit gets bigger. When the deficit gets bigger, the government issues more bonds. When more bonds hit the market, supply increases. When supply increases without demand, prices fall further. The cycle feeds on itself. Let me give you numbers. If these 5 countries sell another $400 billion over the next year, and if other countries see the selling and start exiting too, total foreign selling could hit $800 billion or more. Currently, foreign holders own $8 trillion in treasuries. If 10% exits, that is $800 billion. Who buys those bonds? Domestic buyers might absorb some, but American institutions already hold trillions. They do not want more. The Fed could buy them. But that means printing money. Printing $800 billion would reignite inflation. If the Fed does not print and domestic buyers do not step up, then yields have to rise high enough to attract buyers. How high? Maybe 6%, maybe 7%. At 7%, the government's annual interest payment on $38 trillion would be $266 trillion. That is more than half of all tax revenue, just for interest. At that point, the government faces impossible choices. Default, print money massively and cause hyperinflation, or cut spending so drastically you trigger a depression. There are no good options once the cascade starts, and cascades are hard to stop. Confidence is built over decades. It is lost in weeks. We have seen this before. Mexico, 1994, Asian financial crisis. 1997, Russia, 1998, Greece, 2010. In every case, the crisis seemed sudden. But the warning signs were visible months earlier. Foreign investors selling, debt unsustainable, borrowing costs rising, political dysfunction preventing solutions. The US is showing all the same signs. The difference is America is the world's reserve currency. When Greece collapsed, it hurt Greece and Europe. When America collapses, it hurts everyone. Let me bring this to your level. Your money, your savings, your life. First, interest rates on everything go up. Mortgages, car loans, credit cards. If Treasury yields spike, all rates spike with them. A 30-year mortgage that costs 6.5% today could cost 9% next year. That is $1,000 more per month on a $500,000 mortgage. Second, inflation comes back. If the Fed prints money to buy bonds, that floods the economy. Prices rise. Your grocery bill increases 20%. Gas goes up. Rent goes up. Wages do not keep pace. Third, the stock market crashes. Your retirement account loses 30 to 40%. Years of savings vanish. Retirement gets delayed 5 to 10 years. Fourth, unemployment spikes. Companies facing higher costs lay off workers. The unemployment rate jumps from 4% to 8%. 10 million people lose jobs. Fifth, government services get cut. When interest consumes all revenue, nothing is left. Social security benefits reduced. Medicare cut. Infrastructure crumbles. This is not alarmism. This is what happens in every debt crisis. Argentina, Greece, Lebanon. The pattern is always the same. Debt unsustainable. Creditors flee. Borrowing costs explode. Economy collapses. The only difference is scale. When it happens to America, the effects are global. No safe haven exists. No one escapes. 5 nations are dumping US debt at the same time. China sold $136 billion in 18 months. Japan sold $119 billion in 1 quarter. Saudi Arabia is breaking the petrodollar. Brazil and India are diversifying. Together they have dumped over $400 billion. This is not random. This is a coordinated response to unsustainable American fiscal policy. These countries see the $38 trillion debt. They see the $2 trillion deficits. They see the political dysfunction. And they are exiting before the crisis hits. The cascade is starting. Foreign demand is falling. Borrowing costs are rising. The deficit is growing. More bonds are issued. Less demand meets more supply. Yields rise. The spiral accelerates. You are watching the end of dollar dominance happen in real time. Not all at once. Not in a single collapse. But gradually. Then suddenly, one country at a time reducing exposure. One treasury auction at a time with weaker demand. 1 basis point at a time of higher yields. And most Americans have no idea because the media is not covering it. Politicians are not talking about it because acknowledging it would trigger the panic everyone is trying to avoid. But the 5 nations selling American debt are sending you a message. They are telling you the foundation of the global financial system is cracking. They are telling you American fiscal policy is unsustainable. They are telling you the dollar's reserve status is ending. The only question is whether you listen and prepare or whether you ignore it, until preparation is no longer possible. Subscribe now for continuing coverage as this develops, because it is developing fast. And the decisions you make in the next 12 months will determine whether you survive what is coming or become another casualty